Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and today we are going to start March June 25 latest consolidation past paper of FR. Okay, so okay, before we move on, let me share you some I would say some recent results, because yes, a lot of positions at the time I'm recording this class a lot of positions yet to announce. Okay, so good news is this time in June 2025 attempt, you can see we got all the positions of applied skills module of Pakistan top. See, FPM, TX, FR, AA, FM. And one more thing which is missing. This TX is not only one student. I have two students this time. Two students. They both scored 97, 97. 97. One guy is Kaldeep and the other guy's name is Yasir. Okay. And he messaged me today or day before yesterday. So that's why his post is in process. So there are two Pakistan top, same position with two guys. Okay. So this is for your motivation, that when they can do, why can't you? They have studied everything what you are doing. Okay, they did with the same lectures, with the same trainers, so you guys can also do it. Okay, so it's a proud moment for us, for you guys as well, right? Now this is the question. The name of the question is S company. Okay, ST, I would use the word ST for parent. This is parent and this is SM for subsidiary. ST for parent and SM for subsidiary. Now, before we move on, let me guide you some basic things, very basic stuff. Even I made a short video for this as well. Okay, and this is the summary. This is the summary of consolidated income statement. Consolidated income statement. Just look at the screen. Let us say this white pen is parent company's income statement and this the other pen is subsidiary company income statement. If there is something wrong with the parent company income statement, or we are going to increase the expense of parent company, or we are going to change something in the parent company's income statement, so it will automatically affect the consolidated income statement. Why? Because parent company data is combined in the group, right? So whatever problem is there in parent company's income statement, automatically that problem will go in the consolidated income statement. So we need to fix that problem in consolidated income statement. But now this other pen, let us say this is the S company's income statement. Now if there is any problem in S company's income statement, so it will not only affect the consolidated income statement, but it will also affect NCI. Why? Because S company data is added together in the consolidated income statement, so automatically it will impact consolidated income statement. Second, from S company's profit after tax, using the S company's profit after tax, we calculate NCI. So if there is any problem in S company's income statement, automatically this problem will go in NCI. Okay, so the short summary is, if problem is in parent company's income statement, it will only affect consolidated income statement. But if there is a issue or income or expenses, something plus minus in S company's income statement, it will affect two places. Number one, it will affect consolidated income statement, and number two, it will affect NCI. Okay, so this is the best concept to recall everything, complete lecture. Okay, although you have done the lectures, but still. Now let's start. ST company acquired, this is parent company, acquired 80% of the ordinary shares of SM company. See, the holding is 80%, that means the NCI is 20%. Very simple. On first, yes, always, this is now routine. On 1st April X8. So this is the acquisition date. Now Your year end is 31st December x8, so it's going to be the part year acquisition. Listen, this is your accounting period 1st January x8 to 31st of December x8, and this is your takeover date, which is 1st of April x8. Okay, 1st of April x8. So in this fiscal year there is only 9 months. S company data will only be added for 9 months. This is the income statement question. Be careful. And you guys know that income statement is always for the year. Income statement is always for the year. So if you want to show the picture of this complete year, parent company is obviously with us for the whole year. We are the owner of parent company, but S company is with us for only 9 months. So all the data of S company, sales, cost of sales, everything including the NCI, everything will be prorated for 9 upon 12. Be careful with 9 upon 12. Yes, there are some exceptions for this, but normally it's going to be 9 upon 12. Okay, so this is the heart of the question, the basics of the question. Okay, now draft financial information is presented below. See, statement of profit and loss and other comprehensive income for the year ended 31st December x8. Listen, these are the revenues, cost of sales, everything for parent company and subsidiary company, and then we have OCI. Then we have total comprehensive income. Now before we move on, let's do some adjustments, and these are revision days, so definitely I'm sure you guys know the basics of consolidation. Now the first thing, fair value adjustment. The fair value of the net assets of SM subsidiary, see this is S company, subsidiary company, at the date of acquisition was equal to the carrying amount except intangible assets. The intangible asset had a carrying amount of 25 million and fair value of 35 million. Now that means straight away upward fair value adjustment of 10 million, upward fair value of adjustment of 10 million. Okay, now one thing, but fair value adjustment only hits your goodwill and balance sheet things. Okay, but we are doing income statement right now. They were estimated to have useful life of 20 years. Yes, it has a finite life. So definitely we need to calculate excess depreciation. Why excess depreciation? Because S company does not know anything about this revaluation, but for the group purpose we have revalued, we have changed the value of this asset. So definitely we need to adjust the depreciation as well. You know this thing, excess depreciation. Okay, now how to calculate it? Very simple. It's going to be 10 million fair value adjustment. 10 million means 10,000 divided by the life is 20 years. Okay, so this is going to be 10,000 divided by 20 years. See, open your eyes, 20 years means per annum. So per annum depreciation is, I think, 500. But subsidiary company, we are doing income statement, and income statement is always for the year. So subsidiary company with us for only 9 months, so we need to make 9 months adjustment. So 500 into 9 upon 12 is 375. 500 into 9 upon 12 is 375. Okay, so this is the excess depreciation. Now what they are, excess depreciation, or you call it excess amortization, both are correct. Obviously it's intangible asset. Now amortization charges are presented in admin expenses. Wow, very good. Normally in my course when I taught you guys, and in 99% times you have seen in past papers as well, that this excess depreciation is adjusted in consolidated cost of sales and NCI. But right now what they are saying, it will be adjusted in admin expenses. So do not adjust consolidated cost of sales. Do not touch consolidated cost of sales for this transaction, because examiner has clearly stated. Now even teacher can't do anything. Now even teacher cannot do anything, right? Okay, so now what are the two steps? Just two steps for this extra depreciation. First of all, definitely it's an upward fair value adjustment. So in the group books the asset has gone up, but in the subsidiary books the asset is still down. So we need to book some extra depreciation expense. So our admin expenses will go up Our admin expenses will go up by this amount will be added in admin expenses. Okay, one thing. And yes, as this is the asset of S company, as this is the asset of S company asset, so it will definitely impact NCI. It will definitely impact NCI. And how it will impact NCI? It's an expense, extra expense, so it will reduce your profit. So in the calculation of NCI, first we'll write S company's profit for 9 months, and then we'll deduct this 375, and then finally we'll apply 20%. So we will be getting NCI. Okay, so these are the two things, very simple. Number 2, after 1st April X8, Sminner company sold goods to ST company. That means S to P sale. That means S to P sale. Subsidiary, Sminner means subsidiary, S to P sale. Okay, for a total amount of 15 million. Let me elaborate. Now listen one thing. Right now I'm discussing the question, so I'll give you more time here. But when we'll go to the software and Excel thing, we'll go a little quick because we have to save time. Okay, but this thing I'll explain you in very extreme detail because this is all understanding. This is the real part of the game. Okay, but at the time of Excel, don't tell me to repeat again and again. Okay, that time you need to be very active because I have already explained. Now, so it says to P sale, S to P, 15 million means 15,000 sales. Okay, now they are saying that this is very basic transaction. Sminner company charges a markup on cost of 25%, and stipulate company has sold 75% of these goods to the third party by the year end. So we need to calculate URP. Now wait. We'll write SCP percentage and dollars. The sales price for the S company is 15,000. And how S company calculate profit? How S company using markup? So in markup, cost is always 100, profit is 25, so this is 125. Can you shuffle it? You will get total profit. First is in the first step you will get total profit. So 15,000 divided by 125 into 25. 15,000 divided by 125 into 25, it's going to be 3,000, right? It's going to be 3,000. So the total profit is 3,000. Now wait. Now just one step, 1 second game. Now you just tell me how much percentage of goods are still unsold at the year end. How much percentage of goods are still unsold at the year end? See, it's going to be 25% because they are saying 75% of these goods are still have been sold. So 25% is unsold. So yes, this is your URP. 3,000 to 25% is 750. Yes, this is your URP. This is your URP. 750 is your URP. Now, just let me tell you the steps because I have already covered you these topics in detail. What are the steps? What are the steps of S2P sale? What are the steps of S2P sale? The first step of, I'm talking about the income statement. The first step, this amount of transaction, this amount of transaction will be reduced from consolidated sales and consolidated cost of sale. Number one. Step number two, this URP will be added in consolidated cost of sales. Two steps. Okay. And the third step, as this is S2P sale. So in the calculation of NCI, we need to remove this URP as well. In the calculation of NCI, we need to remove this URP effect as well. Okay. So these are the three steps we have to do. And yes, in the basic level, this level, you have done this S2P sale of inventory many times. Next, Isminer Company, S Company paid a dividend of 1 million. There is a dodge in this question. This is the dodge. 1 million on 30th November. Paid a dividend means total dividend. Paid a dividend means total dividend. Paid a dividend means total dividends. Okay. So now we go very slow, very simple. See, this is P company. Wait, this is S company, and as you know, the holding is 80%. So they are saying S company has paid total dividend of 1000. S company has paid total dividend of 1000. So there, when parent company has got 80% ordinary shares, that means 20% ordinary shares of S company with NCI, definitely. So now S company has paid total dividends of 1000. So from this 1000, 800 will go here and 200 will go here. Very simple. So out of this 1000, 800 will go to the parent company house, right? And parent company, as the parent company is investor, so it's going to be the investment income for parent company. It's going to be the investment income for parent company in the individual books, in the parent company's individual books. But from the consolidation point of view, this is within the group transaction, so we need to cancel it. We need to remove this 800 from consolidated books. Okay, from consolidated books. Now listen, see, this is the investment income, and out of this 1000 we'll remove 800. Now this is the dodge. They have also written in the question, they have written 1000, and already 1000 is written here. So student, what student will do? Student will remove complete 1000. That is wrong. See, that 1000 was the total dividend paid by S company. So it will be distributed between parent and NCI. So parent share is only 800, 80%, right? The remaining 20%, the remaining 200 is the genuine investment income of parent company, which we should record definitely. That means the remaining 200 of investment income are from other sources to P company, and that will definitely be recorded in consolidated income statement. Okay, now this is also very good. This is excellent transaction. Excellent. You know one thing, I'm sure you guys know because you have done this topic before. There are certain transactions which are for the year. Listen, which are spreaded equally over the period. So we need to apportion 9 upon 12. We do 9 upon 12. But there are certain transactions which are one off. All of a sudden it happens. All of a sudden value increases. All of a sudden impairment is done. One off transaction. So one off transaction are never prorated. Sorry. So one-off transactions are never prorated. Now use your brain, use your common sense, read it. Isminer company means subsidiary company. Recognize a revaluation increase on property of 5 million on 31st December X8. This is the act of that day. This is the act of that day, event of that day. This is not the for the year event. So do not try to apportion it. This 5 million will go as it is in the 9 months, because it belongs to this last day. It is not a for the year thing. It is not a for the year thing at all. Let me say this thing in Urdu Hindi language. ये पूरे साल का चीज नहीं है, पूरे साल की फॉर द ईयर चीज नहीं है, ये वन ऑफ इवेंट है, एक दिन का अमल है. So that's why complete 5 million will be recorded as it is in the consolidated OCI. Definitely revaluation gains goes in OCI. Okay, and yes, as this is Sminner means subsidiary company, so subsidiary company revaluation reserve will go in consolidated OCI first, and then in the NCI calculation it will also go. You guys know that in the NCI, because this is subsidiary company's OCI. Okay, and yes, this is a one-off event, so you don't need to apportion. It will go as it is, 5 million in last 9 months as it is. Okay, it's not a it's you do not need to apportion it. Okay, now The last thing is associate. Very simple. Let me recall you, because there is a theory as well, theory part as well for this. Associate, when you have significant influence, in any company, you you for you that company is associate, and you are parent and that company is associate, and now you have to do equity accounting one line adjustment. Okay, remember. So on first, see the date again, 1st April X8. Stuipulotu parent company acquired 30%. 30% means more than 20 and less than 50. So normally significant influence comes with this, but yes, they will also tell you. Of the ordinary equity share capital of hard horse company, this is the name of associate. ST company means parent company has significant influence, yes, over H company. H company generated profit for the year, complete year profit is 20 million. Complete year profit is 20 million. Can you see? Complete year profit. Okay. So I will apportion it to 9 upon 12. Now, the investment in H company was found to be impaired. The investment, see, they are not talking about complete company. They are not talking about the 100% company. They are talking about our investment. Our investment, which is already 30%. So they have given you ready-made impairment of 30% share. They have given you ready-made impairment of our investment, and our investment means 30%, so it's already prorated, so you don't need to apportion this 1 million. Okay, no need to apply any percentage on it, as the market in which it operates saw a significant decline following the acquisition. Now, how you will do it? Just for associate, just do in the SOFP as well as in the income statement. For associate, in the SOFP as well as in income statement, just one line adjustment. What is that one line adjustment? Listen first. For SOFP, the one line adjustment is cost of investment. Add post acquisition retain earning plus OCI. If there is any change in retain earning or any other equity changes of associate, you need to apply the share, you need to apply your share, and you need to add back in carrying value of investment in associate. So this is for SOFP. And in the income statement, just one line, and that one line is associate share of profit. In the income statement, you need to do associate share of profit. That's it. Okay, right? But the good luck is that you have a 4-mark theory requirement for this. I'll explain you. Easy requirement. Listen. Listen. As we have acquired this associate during the year, so this date and this date, only 9 months gap. 9 months gap is for the year. For the year, we will also use 9 months. And for as at, if I'm talking about SOFP, also 9 months profit will go in the SOFP, right? Okay. So first, let me calculate associate share of profit. How we calculate associate share of profit? Very simple. Go simple. Go simple. First, tell me what is the complete 12 months profit of associate. It's 20 million, means 20,000. First, do 9 upon 12. Okay. So you got 9 months profit, which is 15,000. Okay. Multiply by your holding is 30%. So it's 4,500. Okay. So this is your associate share of profit. But be careful. You have done. I'm assuming that you have already studied the chapter. Definitely it's a revision days class. Past paper class. So if you have any impairment of your investment in associate, then simply deduct from here impairment 1,000. So directly report 3,500 in your consolidated income statement. Directly report 3,500 in your consolidated income statement. Everything will come in this. Everything will come in this. Everything will come in this. Okay. In this 3,500, everything is there. Everything is there. Okay. Why I have included here? Because this impairment is parent company's loss, so it will definitely go in the parent company's income statement, and when it is going in parent company's income statement, it is going to hit in the consolidated income statement. So why don't we do it directly with this head? So that's why we do. And this is the recommendation of standard as well. Okay. Now, if somebody says it's this is not the I've just solved it for income statement. Okay. I have not done it for SOFP. Wait. If somebody asks me, sir, what to do for the SOFP? Listen, for the SOFP, I'll write COI, but there is no COI is given. And then I'll add this simple 3500 in it. So you will get carrying value of investment in associate. This is the shortcut. COI, cost of investment, add this 9 months, because in this quest, the gap between acquisition date and reporting date is only 9 months. So an SOFP is always as at, SOFP is always as at. So we'll write COI, add post profit, post share of associate with the impact of impairment, impact of impairment of that investment, and then finally you will get carrying value of investment in associate. Okay, so this is how we have to do for the SOFP. And as a student, you may ask one thing, sir, why are you discussing SOFP? Why are you discussing SOFP when this is the question of income statement? Very quick answer, very quick answer. Because there is a 4-mark theory requirement as well. There is a 4-mark theory requirement as well. I'll explain you, don't worry. Now, before we move on to point number 6, let me deal with the theory requirement, because I will be shifting to I'll be shifting to the Excel part, and in that Excel part I won't be able to come back to the theoretical requirement. Okay, so I'm going to discuss first of all this B requirement, 4 marks, and this is genuinely cash marks. Explain the principles behind the accounting treatment of hard horse means associate. This is your associate. And summarize for hard horse company specifically. See, you have to link how this would be recognized in the stipulated group of statement of financial position as at 31st December X8. Okay, so whatever data is given, you need to discuss that data. Okay, first of all, as parent company is an investor, and there are, in my class when I teach like this, that there are certain levels of investment. The peak level is subsidiary, means you have control, you can do anything. Okay, so subsidiary is the peak level. Then you have associate, you have significant influence. Significant influence means if there are 10 directors in the company, you can appoint 2 or 3, 2 3. Okay, so that means your voice is going in the board. Then there is a level of trade investment, which is IFRS 9. Okay, right? So right now we are talking about associate. So whenever you have significant influence in any entity, that entity becomes associate for you. And now you have to do equity accounting, which is one line adjustment. Okay, in the income statement, just associate share of profit. In the SOFB, carrying value of investment and associate. Very simple, the things which I have just explained to you. I have some written thing for you, so please check it out. Just check it out. Equity accounting is the method used to account for an investment. Yes, parent company is an investor, so parent company is doing investment. Parent company is doing where the investor is deemed to have significant influence over the investee. Yes, associate is the investee. Significant influence is the power to part. Yes, this is the definition. If you have studied from me in my class, I write with the pen. This is significant influence is the power to participate, not govern. Power to participate only. in the financial and operating decision of an entity, but it is not control or joint control of the, it's not control. Okay, right? So this will give you almost 1 mark or more. Okay, now the investment in hard horse is initially recognized at cost. Yes, whenever you buy as associate, you record it at cost in the statement of fund, and later it is adjusted for the group group share of post acquisition profits and OCI as well. Okay, profits as well as other comprehensive income. So one more mark you can get. For the year ended 31st December, the carrying amount of the state will be increased by 4.5 million. And then see, this is 1 mark, and then you will have one more mark with for the impairment. Okay, reduced by impairment. So 4.5 means 4500 less 1000. I have already explained you the net amount of 3500. I have just explained you the net amount of 3500. Okay, so this is how you need to write in very simple terms. This is not abnormal English. Yes, you can change the words, but you need to give the basic message. And these statements you have listened many times with your teacher, and you know I have taught you many questions. All attempts past papers are covered in my LMS, pre-mock, and a lot of things. Okay, so this is going to be your 4 mark thing. This is going to be your 4 mark thing. Now there is only one last requirement is left. I have explained you the associate for income statement already. Now this is 6. Now read the first line. ST company means parent company. So now this is the transaction of P company. This is the transaction of P company. It will only affect your consolidated income statement, not NCI. This is the transaction of, this is the investment of P company. ST company issued 10 million. Issued means company has taken loan. There are two statements. One is issue of loan notes means you have taken loan. One is investment in loan notes means you have given loan. So this time we have taken loan. It's a liability. It's a liability. And yes, against the liability we need to book interest expense. So ST company issued 10 million 5%. This is the coupon rate. Coupon rate. Hope you remember IFRS 9, my lectures. On 1st April X8. Again, 1st April X8 means during the year, at the acquisition date, at nominal value. At nominal value, that means no discount or no issue cost, nothing is involved. Exact cash, same amount of cash came to us. With the interest payable annually, no issue, in arrears. The effective rate is 12%. If you guys know the essence of IFRS 9, if you have done IFRS 9, so you better know IFRS 9 says IFRS 9 says that book interest expense using effective interest rate, because listen my word, effective interest rate effectively includes everything: premium on redemption, and remember, discounts, issue cost, everything, physical interest, everything. It no. Okay, so the initial issue of the loan note has been accounted correctly, very good, but no other entries have been made. That means no interest expense has been recorded. No interest expense has been recorded. Okay, so we need to record the interest expense for 9 months, additional interest expense for 9 months. I'll do it for you, but you all know that interest expense will be booked using the effective interest rate. Okay, and yes, the issue date is 1st April X8. So that means if I show you the for the year picture, so this year we have used only for 9 months. This year we have used it only for 9 months. We have used it only for 9 months. Okay, so how do we calculate 9 months interest expense? Let me tell you. 10 million means $10,000 loan into 12% into 9 upon 12. This is going to be 900. Okay, 900. Yes. And yes, as it is it belongs to P company, so it will only hit your consolidated income statement. That's it. No NCI. Let me help you with one thing. See, can you see the finance cost? This 3000 is the parent company finance cost, plus I have just done plus 900. We'll add more for this transaction, 3000 plus 900, and this 1400 we'll do 9 upon 12. Now this will be your consolidated answer, 3000 plus 900, because 900 is parent company's interest expense and parent company's interest expense will go complete. So 3000 plus 3900, then plus 1400 into 9 upon 12, because we are doing 9 months consolidation with subsidiary right now. Okay, so 1400 into 9 upon 12, one zero five zero. So this is 1050. Wait, 3000 plus 900 plus 1050, 4950. Yes, this is your final consolidated interest expense. Consolidated interest expense is 4950. Consolidated income statement is 4950. That's it. Okay, now we have almost done, everything for this question, and we are ready for the Excel part. See, prepare this. ST means parent company's group consolidated profit and loss and other comprehensive income for the year ended 31st December X8. Listen, this is the gain on revaluation for P company. It always goes complete, and this 5000 will also go complete. Why? As a student you may ask, sir, why we are not doing 9 upon 12? Why we are not doing 9 upon 12? Why we are not doing 9 upon 12? Because this 5000 is the post period revaluation, number one, and it hit on one day, and that is 31st December X8. So that is this 5000 is not a for the year thing, and as this is not a for the year thing, so no need to apportion it, no need to it will go complete as it is, plus 5000 we'll add. Okay, so before we move on to the software Excel part, my request is to take the picture of this question if you guys want. If you guys want to take the picture, please take it, or if you have this question, it's okay, otherwise take it, because now I'm not going, I will not be coming to this screen. I will not be coming to this screen anymore. Okay, so you must have. Also, this is the question. Please take the picture if you want. Please take the picture if you want. I I can tell you now. And these are the workings we have just done. See why am I explaining with this pen and paper? Because I want to teach in what we call in a natural way, so that you can easily understood. The main objective is understanding. Then the software work is normal. You do a lot of practice. You daily do. You daily do practice. And yes, for last 40 marks, it is highly recommended to use ACCA platform, right? Let's shift. Before we shift, just think one thing. We are making income statement, and income statement is a for the year thing. So for this complete for the year, parent company is mine, so complete data for parent company, but for subsidiary we'll take 9 months data. Okay, and yes, my dear student, I have explained you everything, so now don't act like kids, right? So dear students, let me show you the consolidated income statement. See, first see the heading consolidated. I have given first heading as consolidated profit and loss, and then I'll give a separate heading for consolidated OCI. And yes, we are doing it. We are doing it using the new latest IFRS 18. IFRS 18, IFRS 18, the new standard. Definitely, you guys have done. It is included in my LMS. So according to IFRS 18, you can make a combined income statement, or you can break up into two statements, but they should be connected. Definitely they should be connected. Okay. So I have given a separate heading for profit and loss, and then see, and then the next heading I have given, is for statement of comprehensive income. Statement of comprehensive income. Okay, right? Or we call it other comprehensive income, right? I will write the heading here, don't worry. So let's start. The first thing is, now go very relaxed. You have done it. You have done almost everything. So go very relaxed. First of all, let me open the question in front of me. Wait. So that it would be easier for me as well. Listen, first of all, parent companies, first of all, revenue. Just parent companies complete revenue will come to 25 million, plus subsidiary companies 9 upon 12C. And thus, yes, there was a S2P sale. So for S2P sale, the first step is 15 million will be deducted. 15 million will be deducted from both consolidated sales and cost of sales. Okay. Now, all these headings I have already given. Why? Because I want to save time. I want to go smartly. Your time and my time, both times are very important. Okay. But yes, in the exam you need to write everything. You need to write these, you need to type it. Okay. We are going smartly, that's why we are saving time. So if you adjust all these three, you will get 297750. 297750. Okay. Then then you have cost of sales. How you do cost of sales? First of all, see, 141 million is the cost of sales of parent company. Complete parent company cost of sales will come. Then subsidiary company cost of sales will be 9 upon 12, so 76.5 million into 9 upon 12. Then there is an intercompany transaction, S2P sale. So 15 million will also see, this 15 million will also be deducted from sales and cost of sales. And then finally there is a URP. Finally, see, this is the calculation of URP. This is the calculation of URP. This is the calculation of URP. Okay. So finally you will get the cost of sales is equal to 184125. 184125. 184125. Sorry. Now the next thing is gross profit. Let's do it. The gross profit will be 113625. 113625. Okay. Then we have distribution cost. So distribution cost is 11.1 million for parent, and for subsidiary it's 4.5 million. So definitely subsidiary distribution cost will be apportioned by 9 upon 12. So the combined effect will be 14475. 14475. Okay. Then we have admin expenses. Your memory should be very good, please. In admin expenses, parent company is mine, so complete parent company admin cost, then subsidiary company admin cost into 9 upon 12. And yes, there was some excess amortization or excess depreciation of fair value adjustment. Remember, excess amortization, see, 35 minus, see this, 35 minus 25 is 10, and 10 divided by, you can do like this, 10 divided by 20 years into 9 upon 12. Here I have written 240. 20 years means 240 months. 20 years means 241. So I have done like this. Okay. So my dear student, if you adjust all these three, your admin expenses will be 25875. 25875. Please use your calculator, you can try it, right? Then a new number according to IFRS 18. Now operating profits. See this subtotal. You have done final account. This is operating profit. My dear student, now you know that after operating profit, there is a section of investment. Now I'm doing investment section. So do we have any investment income? Yes. Parent company has done investment with associate. Yes, parent company has done investment with in associate. So associate share of profit. Remember, associate share of profit. I have already calculated with you. It's 4500 minus 1000. So this is 3500. Associate share of profit is 3500. Okay. Then my dear student, there was an intercompany dividend knockoff. So total investment income, listen, total investment income recorded by P company is 1000, but in that 1800 is intercompany dividends. So we need to knock off. So 1000 minus 800 will give you 200 are genuine investment income. So there is no other investment income. So now a new subtotal is there. A new subtotal of IFRS 18. IFRS 18 is there. 766975. 76975. Okay. Now my respected student, finance cost. I have just explained you just 2 minutes, 3 minutes before I taught you finance cost. So 3 million was the complete. You can see the question. You have the picture of the question. 3 million is the complete. My dear student, 3 million is the complete finance cost of P company. Then there was 1900 as well. And then for S companies 1400, we'll do 9 upon 12. We'll be doing 9 upon 12. So this is going to be 4950. This is going to be 4950. Okay. So now we'll get profit before income tax. Now we'll be getting profit before income tax. Okay. Then we have income tax expense. This is very ready-made. So income tax is going to be for parent company is 15.6 million, and for subsidiary company it's 5.4 million into 9 upon 12. So the total came out to be 19650. 19650. Okay. 196. This is very simple. So now finally we have calculated profit using simple consolidation. Okay, total profit we got 523750 total profit. 52375 is your total profit. Okay. Now let me give you other second heading. Okay, now we will be doing other comprehensive income. So in other comprehensive income, if you have, I repeat, if you have studied IFRS 18, so now in OCI there are two layers. First OCI is that which will never transfer into PNL in future. First OCI is that OCI which will never reclassify to PNL in future. And there is one more OCI that is going to be transferred into PNL in future. Okay. So in this question, as there are only IS 16 revaluation gains, and my dear student, IS 16 revaluation gains never goes in PNL in future. Okay, so we'll only write this head. See this head. Items that will not be reclassified to profit and loss. Okay, and that was your gains on revaluation. Now see the question, please open the question paper with you. So parent company's complete OCI is 10 million. Yes, it will go. And S company OCI is 5 million. That will also go complete. That is post period. And one off thing, it's not going to be apportioned. I've already explained you many times. Please, please. So 10 plus 5 is 15,000. Now let's do total comprehensive income. This plus 6735, 67375. Okay, still we have done big job, we have done the big job. Okay, so we have calculated profit using simple adding together, and then we did OCI using simple adding together. Okay, when I teach in Urdu language or Hindi language, let me say that word, I say हम ही हम करके हमने ऐड कर दिया, हम ही हम. Remember my dialogue. So now in the end we need to distribute the profit. Listen, the profit as well as the total comprehensive income between parent company's owners and NCI. Final thing. But don't worry, don't just jump into that section. First see this solution, first see this area. First, my dear students, see what you have done. See, this is the area of consolidated income statement. Please check it out, please check it out. And I have done this using the latest IFRS 18 format. Okay, you know now income statement format is revised. Okay, now I'm doing some separate working here. I'm calculating NCI. I'm calculating NCI for profit. How to do it? Very simple. S companies profit for 9 months. Okay, what was the full year profit? The full year profit of S company was, I think, 20.2 million. Full year profit for S company was, I think, was 20,200. Yes, 20.2 million. So this will be, wait, 20,200 times 9 upon 12. 9 months profit. Now few adjustment, few less URP, S2P. Remember S2P sale? How much was the URP? It was 7. No, the URP was, I think, 750. Yes, it was 750. Then there was some excess amortization, less excess amortization. Remember, of that fair value adjustment, let me write FVA, and that excess amortization was, wait, let me see, excess amortization was 375. Yes, excess amortization was 375. I've already calculated with you, so you can see with pen I did it. Okay, so these were the two transactions which we need to adjust. So this is your 9 months adjusted profit. Now simply multiply it by your share was 80%. Yes, parent company holds 80%. So NCI will be 20%. NCI will be 20%, right? Okay. Two eight zero five. This is the NCI for profit. NCI for profit. This is the NCI for profit, okay? And this is nothing new for you. Nothing new for you. Now, just give one minute more. I'll add OCI in this as well. If I want to do it. Add OCI share of S company. Now you remember the OCI share. I'm talking about NCI right now. NCI. So in NCI, OCI share was 5,000. 5,000. So we'll do 5,000 into 0.2, 20%. Okay. Let's do it here. Equal 5,000 times 0.2. As a student, you may ask, sir, you are not going to apportion it by 9 months. No, it is a one-off event. It is a one-off event. Okay. So if I add this profit and this OCI, this is NCI for total comprehensive income. NCI share for total comprehensive income. Okay. NCI share for total comprehensive income. Okay. So my dear student, now just see this carefully. This is old thing. You have done it before. Now we need to write 3 lines 2 times. 3 lines 2 times. First of all, the profit breakup. The profit breakup between parent company's owners and NCI. And then the total comprehensive income breakup between parent company owners and NCI. That's it. That's it. Let's do it. See, first of all, let's do it here. What is the overall profit? What is the overall profit? 52375. When we were doing as if we own everything, or in Urdu we say hum hi hum wala profit is 52375. Okay. And out of this, what is the NCI? NCI is I have just calculated NCI as this number C, 2805. Okay. So now what will be the parent companies? What will be the parent company's share? Equal this minus this, 49570. 49570. First of all, I have calculated the breakup for profit. I have calculated the breakup for profit. It's not difficult. It is not difficult, please. It is normal thing. If you have done consolidation, you must know. Even in this breakup is taught in FA level. Now let's do it for total comprehensive income. Now what is the total comprehensive income? Total amount, hum, what we call as if we own everything. This, and then what is the NCI share? See, this is the NCI share for total comprehensive income. Now what is going to be the parent company's shares? The parent company share will be this minus, done it. Everything is done. Complete question done. Complete 20 marks done. Complete 20 marks done. Honestly, it's all about focus. It's all about focus. Even you can do this in exams as well. Okay, it's okay. Is it 20 marks? You score 15, you score 16, 17. Even you can see the position holder of this time. He got 95. He's also human being, normal guy, like you. But definitely you need to focus. You can check it out, please. Okay, finally the question is done. Okay, so that's it for today's class. Thank you and take care. Bye.